Well, thank you all for coming back for day 2 of the seminar. I'm hoping today's will be kind of shed some light on some other topics that were uncovered and really get into some more specifics. The first class was more kind of a foundational, but we did dive deep into a lot of different topics. I'm sure a lot of you had to take some Excedrin by the end of the evening, and I guess that's a good thing in some way. So today what we're going to cover, many different topics again. We're going to talk about Medicare. There's a lot of slides in there. I'm not going to go too deep into it, but I want to have a general understanding of that because there's another topic that, you know, it's not something we learn in school. It's not something we get anything straight on. So I want to kind of touch on that. We're going to talk about long-term care and some of the statistics on that. Tax update, because I am a CPA, I got to put a little tax stuff into here. Although I didn't prepare my own tax return for the first time ever. I'm a really good delegator. Tax law summary. We're going to talk about the 401k rules, and there's some things that any of you with a 401k or know somebody with one may not understand about taking control over those. RMD, required minimum distributions. We're going to talk about conservative investment strategies, which is a big topic right now given the volatility of the market over the last 15 years, given the decrease in the bonds. Remember the last class we showed the slide of 30 years of decreasing bond yields, and that's on its way back up. So we kind of have to have a new model for that. We're going to talk about what moderate asset allocation is, what goes into it. It's not just randomly picking a lot of different funds and saying you got asset allocation. There's some science to it. I'm just going to mention a case study that I did in my Black Book on Personal Finance that was published a number of years ago. Markowitz graph, that's a Nobel Prize winning asset allocation model. We'll talk about that. And how to calculate when we can retire, for those of you who are not. So let's get started. Again, on the Medicare stuff, a lot of slides, but I don't want to allocate a third of my time, even though it might be a third of the slides. It's more of a reference tool for you. We're going to talk about Part A and Part B, some of the benefits from that. Medicare supplement insurance, Medicare Part C, which is a combination, Part D, which is prescription drugs and enrollment periods. When you're up to just before age 65, you're automatically enrolled in Medicare. So what some people don't understand is that when you turn 65, you're eligible for Medicare. That is the government health care program. You don't have to be on an employer's health plan anymore. It is subsidized by current workers. Workers are paying into that plan to give you a cheap plan that covers certain basic things. So that's what basically Medicare is. And so a lot of people are always, oh my gosh, healthcare costs are going to kill me when I get older. Not necessarily, because Medicare is going to cover so much of that. It doesn't cover everything though, and that's what we're going to talk about here. So you can, if you're still working, elect to delay coverage, but there are some implications to that that may make Medicare or Medicare supplements more expensive later on. So you have to kind of weigh one against the other. So if you sign up for COBRA and you continue to be covered, then you're still under your employer's plan and you're not maybe electing Medicare. That can be very expensive for you, so you may want to consider what other options you have. Medicare is Part A, Part B. They'll cover the items listed here. Part B is the one we mostly use, hopefully, there's outpatient services and doctor services. That's what it covers, just basic coverage on that. That's the original Medicare. That's a combination of all of that. Your costs. Now I can guarantee this is supplemented because I just got my renewal notice today for my employees. And I think the cheapest one was well over $500. When you have a couple of them, it's close to $1,000. With kids, it's even more. So you can see that the premiums for Part B are pretty reasonable relative to what current health care costs are, even in a group plan. I was talking to another individual today, her and her son, it's well over $1,000 a month. So just for basic health care coverage, it's going to get worse with Obamacare and some of these other programs. So the over-the-counter type of health care coverage is just going to keep going up and up and up, but this is subsidized by current payroll taxes. You can see that there's some premium adjustments based upon how much you make. So the more you make, the more your premium is. It still doesn't come close to the premium you would pay on the open market. How does the money flow? You pay some of the premium. Department of Health Services pays the rest from the payroll taxes that are collected from the current workers. One of the problems with Medicare is that I know, 30 years ago, I think there were 20, 25 workers per recipient. Now there's something like 3. In another 15 years, there'll be 2 workers for supplementing every 1 person on Medicare. That's a problem. The fees are then paid to fee-for-service claims or private insurance Medicare Part C, which we'll talk about in a second. So here's 2 of the basic options. What most people do is they sign up for traditional Medicare. And again, Medicare just covers certain things. And I have a great chart coming up, so I won't get too into that until I get to the chart. But it covers the Part A and Part B, and then you add a standalone policy called a Medicare supplement. It really doesn't matter where you get the supplement policy from. Whatever type of supplement you sign up for, the rules are the same, whether it's through AARP or Mutual of Omaha or whoever. It doesn't really matter. And then you'll add a standalone prescription drug plan on top of that, Part D, which is a separate part. Or you can kind of get the all-in-one. It's called a Medicare Advantage plan. It's many of them are integrated, so it's just kind of a one-size-fits-all. That's more your HMO, PPO kind of thing. And so you can go that route. This talks about how it works. I'm going to skip through this graph. Medicare supplement plans talks about how they are standardized, as I mentioned. And each plan has a letter assigned to it. So the network and benefits included in the plans you choose are the same no matter which insurance company you select. And here's the graph that I was talking about. As you can see, there's about 10 choices here. And the more check marks there are, the more it costs, because the more it covers. If you never are going to travel overseas, for instance, you probably don't need C, D, F, or G. Some of these covers deductibles, some don't. Some cover more of the hospice care, some a percentage. You can just go through here. The one that covers the most is F. I don't know why they didn't put them in order. That would make a lot of sense to me. A is the cheapest, N is the most expensive and covers the most. That would be common sense, and this was put together by our federal government. So here we go. So as you analyze which plan you're going to need, you want to think about what kind of coverage you might need. Sign up for that, and you'll receive that coverage. Part C again was the kind of the group plan where everything's kind of rolled in together. You'll have to look at service areas for that. This talks about the mechanics of it. I won't get into the mechanics of that. That's beyond the scope of this class, but it's a reference thing for you in case you're interested in that. You'd be working with HMOs, PPOs, EIEIOs on all of this if you sign up for that. Medicare Part D, that's the prescription drug part. It is optional. It's provided by private insurance companies. Premiums vary by plan. The basic monthly premium is $31.17 a month. It's probably a good idea to sign up for that. This talks about how it works, the deductibles, how they pay. There's a coverage gap. As you're talking with your Medicare person, this is something you talk about, the variations of the Part D, so you're covered properly. There is, again, a surcharge. If you make too much money, they're going to charge you more. So, not a whole lot more, though. I can guarantee I expect to pay more than $66 a month on prescriptions when I'm older. Pay more than that now, never mind. It takes a lot to keep a machine like this going this well, you know. This talks about enrollment periods. There are specific enrollment periods. We're coming up on one for the annual election period, 10/15 through 12/7 for the new year coming forward. So that's when you're going to see a lot of this stuff on TV in your mailboxes if you're around that age. And they have disenrollment periods, and special election periods, and I want to keep all of you awake, so we're moving to the next slide. And we're going to get into long-term care. I have a question about Medicare.
Yes, Brian. Are there any circumstances by which you can access Medicare if you retire early, before age 65?
Yeah, the question was, can you access Medicare if you retire early? There's disability that can kick in. Yeah.
With disability?
Yeah, with disability. There's also Medicaid planning that can be done, where I had a situation where a couple had significant assets and they were in their early 60s. One of them had early onset Alzheimer's. Well, they saw this coming, they transferred the assets to the wife, and after a period of time she bought a single premium immediate annuity. So they transferred their 7 figures into that. Then they applied for Medicaid. That did not count as an asset because they had no longer access to it. He was able to apply for Medicaid because he maybe had 20 years of deep care ahead of him, and that would have taken all the money. And she was able to get back the million plus over a 7-year period in this case to reinvest it later, but it was her separate asset at that time. So there is planning that can be done to protect the assets if you have a situation such as that. Long-term care, just some statistics. 31% of you will never need long-term care. So that's 10 of you. The rest of you may. 1 year or less, 17%. 1 to 2 years, 12%. 2 to 5 years, 20%. And more than 5, 20%. So actually, statistically, more people will need it more than 2 years than will never need it. But you all look really healthy in here, so I'm assuming you're all in the 31. So I think we're good here. Men and women and coverage. One of the things that somebody who's promoting you buying a long-term care insurance policy might point out that if you own a house, do you have house insurance? Well, of course you do. But only 2% of you are going to need to access that. Do you have car insurance? Well, of course you do. Well, 15 to 18% of you will really need a severe car accident claim. Do you have long-term care insurance? Many of you do not. Well, 44% of men and 72% of women would need it at some point in their life. So, just a statistic. Who benefits from long-term care? Single women the most, 41%. Single men, only 12%. It's because single men don't take care of themselves very well when they're older. They just don't last as long. That's the truth. Because married men, 22%. Married women, 24%. Let's skip gears now. That was just some stats on long-term care, just to kind of get you maybe thinking along those lines. Well, let me go backwards just a little bit. On long-term care, there are actually, if you don't have a whole lot of investable assets, typically long-term care is not going to be something you're going to even think about getting, because Medicaid is going to cover you. If you have fairly significant assets you want to protect, then it could make some sense for you, depending on your situation. If you've got boatloads of money, millions and millions and millions of dollars, most of those people don't sign up for it because their own earnings on their investments are plenty to cover any potential. I'm not saying it wouldn't make sense, it just that's kind of the case. But somebody comes to me, they have $200,000 of assets or $100,000 or something like that, and there's no point to even talking about it, because Medicaid is going to allow you to have a certain amount of assets, and so why would you use up your current assets when somebody else is going to pay that bill down the road anyway? All right. We had tax law updates. I won't get too into this one either, because I could really bore you with this stuff. And if I couldn't, David here could, because he even knows more tax law than I do. So, right, Mr. Rumsey? They have new rates here. We have the 39.6% rate now. We have, it's a graduated rate. I want to point out on marginal rate, there's a lot of confusion about marginal rate with a number of people. Like, they'll come in and say, oh my gosh, I'm paying a third of what I make. And I'm like, I don't think so. And I'll look at their return, I'll say, really, you're paying about 10%. Like, how can that be? Well, some of your earnings are taxed at 0. Some at 10%, some at 15%, maybe some at 25%. And you have itemized deductions, you have standard deductions. So if you go to your total tax line divided by your total income, very often I'm seeing those numbers between 10 and 18%. That's your average tax rate, net. And so people sometimes overestimate. The marginal tax rate is just the next dollar of income I have on top of my existing. That's the rate that's being taxed at. So average tax rate is very different from marginal tax rate. Does that make sense? This is more of a reference to talk about the tax brackets. It's in your information there. There's been changes to, there's all these phase outs and alternative minimum tax. Interesting story about alternative minimum tax. It was originally created because Congress was mad about something that Frank Sinatra said. He was claiming he didn't pay any tax because of his deductions. So some congressmen got upset about that, and they wrote the alternative minimum tax to cover those folks that were in a high bracket that were using tax loopholes and so forth, I guess you'd call them, to get out of it. I understand, I'm not sure of this, but I was told it covered 8 people the first year. Now I don't remember how many millions, maybe David, you know, but I think it's tens of millions it's affecting now. It was never intended to be covering tens of millions of people, but they haven't really updated the rules on that. And, well, they've made it even, they see it as another revenue source. And so essentially, when you do your tax return, you do it twice with two sets of rules. You do it under the regular rules, you do it under alternative minimum tax rules. If you have rentals, you depreciate them under regular rules and alternative minimum tax rules. When you have K-1s, you have tax AMT adjustments. There's all this stuff that goes into it. So that's why our tax returns don't cost $50. I mean, that's one reason we have to do two sets of rules on tax returns. That is the alternative minimum tax. Here's one that I'm finding is affecting some people. Beginning in 2013, net investment income, which includes capital gains. So if you're selling something with a big capital gain. I had a client today, she's selling a house, and she's single, more than a $250,000 gain. It's in Medina. She's not only going to have to pay a higher capital gain rate than she figured a couple years ago, but now there's a new 3.8% Medicare tax on higher income, capital gains, interest, and dividends. So CD interest, dividends from your stocks, or a big sale in capital gains, we're going to have another almost 4% tax that's going to go right to Medicare. So another supplement because of the fact they're not collecting enough to cover the expenses. The IRA charitable rollover was restored also, where you can gift your required minimum distributions directly to your charity and get the deduction for that. We covered state tax laws in the last class. The rate has increased from 35 to 40%, but we can still leave $5.25 million on the federal level, but it's only $2 million on the state level. Any questions on some of those tax law changes? Now we're going to talk about 401k plans. A lot of people in the past, the statistics were that most people, of course, worked at one place their whole life. They got a pension. Pension paid them for their whole life. Then in the in the 80s, along came 401k plans. The 401k plans grew and grew and grew and grew until now most employers, that is all that's offered. They don't have pension plans anymore, including Boeing, which stopped offering pension plans. They're offering 401k plans. So what they've done is they've shifted the burden of investing your retirement assets from themselves to their employees. Now I know for a fact that most employees, maybe they're good at fixing their car or they're fixing their house or whatever, not so good at asset allocation models. It's maybe not what they were trained in. Would it be fair to say that? Yet they get the stacks of prospectuses and they look at them and the results are really really sad sometimes because they don't know what to do. And so they'll put them into something and they'll just leave it, of course. And maybe it's not the right thing or doesn't have the right mix. And this is what they're going to live on their whole life. And they don't get any help. The fees are very high, very often. So there's a lot of problems with 401k plans. There are solutions. We're going to talk about some of those problems right now. The first issue I want to talk about, though, is an opportunity. Because as we learned in the last class, there are other asset classes that may be something you'd be interested in as you approach retirement. But you might be stuck in a let's pick on Boeing for a minute. They have a terrible selection of investment choices in their 401k plan. It is plain vanilla. If you want bonds, they have, I think, one choice. Well, I don't want treasury bonds. I want some other kind of bonds. Brian told me there's 15 major categories of bonds and a ton of subcategories. I don't want to buy 10-year treasuries at 1 point something %. Sorry, that's your choice. That's it. So Most 401k plans are set up with between 12 and 25 choices. That's it. And I even looked at the Boeing plan. I remember the large cap US choices were all completely correlated. We talked about correlation in the last class. They're the same thing with a different name on it, essentially. They're all market cap weighted indexes with slight variation. So how do you take control of your 401k plan before you retire? Well, at age 59 and a half, most 401k plans allow you to do what's called a in-service non-hardship withdrawal or distribution. Meaning that while you're working, you can roll all of your balance into your own IRA and continue to contribute to that old plan and get their matching and their free money. That's what you should be doing. But you can take the bulk of the money out and take control of that. In the plan, you have, say, 15 choices. Outside of the plan, 20,000 mutual funds, 3,000 ETFs, guaranteed income for life, no risk type investing option. You got everything. You can do anything with it outside of the plan relative to what you can do inside. Now, one of the questions I might ask somebody that has that opportunity, would you rather have more options and more control, or very limited options and no control? Seems obvious, but I guarantee less than 1% of the people are taking advantage of this. They just don't know about it. And they could design a plan for their future at age 59 and a half and take control of that instead of just relying on the very limited choices. And so this is something that I like to point out because there's always 1, 2, 3 people in the room that go, aha, that's one of those aha moments I'm going for with this class. I'm not going for easy in this class. You may have picked up on that. What do you get when you roll money out of your 401k plan? Another example of this, though, is people that have maybe 6 or 7 old 401k plans. And they just leave the money where it is. It's scattered all over. And the question I always ask them, of course, is, so what's your investment plan for all these assets? Kind of aggressive, moderate, conservative? And they're like, I don't know what's in any of them. It's pretty common that they just kind of leave it there, whatever it was in. If they work someplace in the 90s, they're 100% in the science and technology fund. If they're, depending if they worked someplace right after the crash, they're all in a bond fund. I had one client I remember, he says, well, I'm heavily invested in the stock market, but I can't figure out why my accounts aren't going up. And I was like, that's weird, because this is after many years run on the market, and he was just flat. And so I said, well, let me look at your statements. So he brought him in, and every one of the mutual funds sounded like a stock fund. We looked them up, they were all bond funds. He thought he was in the stock market, and he thought he had bought low. But the American Funds Growth and Income Fund, or whatever it was a bond fund. All of them were bond funds. He thought all of them were stock funds. Just little things like that had a devastating effect because 500,000 was going to be 800 instead 500 was 500. And he thought he even made the decision to do what was going to do well for him. So I think it's always better to have better income solutions, consolidate your assets, and have a plan. I know it makes sense, but not everybody does that.
Say, Brian?
Yeah.
Obviously, 0% in a year is a bad return on a 401k. What would you consider percentage-wise a good annual return?
Well, I'll correct that. The question was 0 is always a bad year in your 401k plan. I would take 0 in 08, 2000, 2001, and 2002.
Okay.
Yeah, I mean, sometimes 0 is your hero. There is, and really the question is, what percentage return should I expect? Well, there used to be rules of thumb with that. Well, those rules are just no good anymore, because we went through remember the graph, the M becoming a W. What's my average rate of return? Well, you tell me the day you invested, and I'll tell you if you're happy or sad. You know, it's really impossible to project in the current times with just the equity markets. So that's why we use a plan of diversification where we have some of your assets not subject to market risk and longevity risk. Some are in other areas non-correlated. So we're trying to reduce the ups and downs and have it be up. And so we're going to talk about that later on here. But yeah, it used to be that the statistics were, hey, invest in the market. The 80-year return is 11%. Well, now they're saying the 80-year return is 7. Oh, boy, that's a big drop in an 80-year return in a few years. What happened? Oh, 08, 01, 02. So it's hard to really say there should be a rate of return. So we talked about consolidating your assets so that you can have a plan. I want to talk about beneficiaries. Situation can be that someone's married, they go to the attorney, spend $10,000, they get a wonderful will, living trust, healthcare directive, durable power of attorney, they're set. Guy passes away. Problem is, in his 401k at Boeing, he had his former wife as a beneficiary. Well, guess what overrides? The beneficiary election on the 401k plan overrides all your wills and living trusts and everything. That's a tough one for the new wife to get over, I would think. So be real careful about who the beneficiary is on your plans, because that is going to override all legal documents after that. Talk about stretch IRAs, that's kind of beyond the scope of this. Protecting principal, we're going to talk about some strategies to do that, just opportunities to, as we get to our distribution years, that we don't want to have quite as much at risk in the volatility. And getting professional help. That's the first one I talked about. When our firm sets up a 401k plan for a group, we provide them with explanations of risk tolerance. We provide them with the actual model portfolios that they can just replicate. We update those models so that they don't have to spend all their time trying to figure out this mutual fund from that mutual fund and asset allocation strategies on their own. So it's really important that they get some help, and the 401k industry is really underserving the population because they don't offer it. I'd say 99% of plans really don't offer any help. What I hear is that they leave it in cash, do nothing with it, or they go to the controller and say, what did you do? That's the two most, or they ask their neighbor, what should I do? That's the most common ways of investing their entire retirement plan. It seems to make more sense to get some help with that. And when we set these up, we don't charge for that. It's just something very important when we run a 401k plan, that I know that they have the opportunity to at least work within their own options and do a proper model. We'll even, if somebody has a 401k plan, I can't manage a current 401k, individual's 401k, but we will, if they want, take a look at that and build a model portfolio for free for them so they can use that going forward. Sometimes I ask, why do you do it for free? Because generally, they're pretty happy with the results, and when they retire, they roll it over. And so it's just a way to plant that seed. You can't see this chart, but it's in your book. This is a page on required minimum distributions. A lot of misconceptions about that, so I'll hit a couple of them. First, what is a required minimum distribution? Well, the IRS has figured out that it needs tax revenue. So what was happening is people had these big retirement accounts, and their expenses weren't very high, so they didn't need to use them. So they just sat there. And IRS is waiting, waiting, waiting. They want their money. They want their tax revenue, but they can't tax it until you take it out. So they said, we're going to require you to take it out. So they got their heads together and they said, at what age should we do it? And they somehow came up with the age of 70 and a half. Now why they didn't just pick 70, I can't tell you, but it's 70 and a half. And in some situations, a year after you turn 70 and a half. Isn't that 71 and a half? I don't know. Anyway, so, but at 70 and a half, you have to take required minimum distributions. And they also decided they were going to penalize you if you didn't. So it's one of the most onerous penalties that exists in the tax law. And so picture this, they got together and decided, well, how should we assess this penalty? Well, let's say that this lady is 95 years old, has Alzheimer's, and has a big IRA account, and forgets to take her $50,000 required minimum distribution until a few days after the first of the year. What should be her penalty? 50%, $25,000. That's the penalty. That's it. No grace period, no nothing. It's $25,000. So the most onerous penalty was put on that portion of our population that's probably least able to know these rules. So it's pretty sad. So it's really important in your 70s that you have a plan for taking your required minimum distributions. You don't have to take the same amount out of every account. Let's say you have 3 retirement accounts and your requirement is 20 grand. Well, as long as you take 20 grand out of one of them, you're okay for all of them. Another question I've had is, boy, I hear when I turn 70 I got to take like 15% of my account out. No. Here's the divisors. Again, I don't know why they don't have the table with a percentage, but you have to take, for instance, if you're age 70, you take 100 divided by 27.4 to come up with 3 point something percent. So you have to take, if you had $1 million, you'd have to take whatever, $36,000 out. If you got $500,000, it's 18 grand or so. It changes every year. If you have all of your assets with a proper advisor, they're going to have your birth dates, and the computers are going to make sure that you get those distributions every year so as not to subject you to the 50% penalty. Or you may have a guaranteed withdrawal benefit, and that amount coming out is sufficient to cover the amount. But it starts out in the 3s to 4s to 5%, 6s, 7s. As you get older, you have to take more out. When you're 110 years old, you got to take a third of it. 115 and over, you got to take half of it. So now I want to get into another topic, conservative investment strategies. I think a lot of people, this is probably the most common conversation I'm having in the last couple of years. And I talk about a lot of stuff, CPA firm, investment advisory, financial planning. This is the one because of that graph that I showed you with the market. Because of the graph I showed you with the bond yields. Because of 2008 in the real estate market. Because of CD rates. Because more of our population is in their distribution phase of their life. So let's talk about CD rates. The things I talk about have changed over the years. The interest rates you were receiving on bank assets in the 2000s, here they are. Now, in 2007 and 2008, we were not talking conservative investment strategies at all, ever. Your uninvested money in the brokerage accounts were earning over 5%. So there's nothing to talk about. That's above inflation. That was fabulous. There was nothing to do. So no one was talking to me about conservative investment strategies. Back here, real estate will never go down. Remember that? Never. It can't. You can't make new property. There's always going to be more people moving here, especially in the Pacific Northwest. People are moving here. Real estate will never go down. I saw people, they'd come into my office and they'd say, well, you know, we bought some rental houses. We project they'll go up about 20% a year. So when we're 50, we'll be worth $18 million. Seriously. I was like, really? That 3-bedroom Rambler is going to be worth $4.5 million in 15 years. Like, yeah, we just projected the numbers. Like, wow. I don't think so. You know, it gets back to, you know, how much is a rental worth? We had in the last class, we talked about the price-earnings ratio. In the real estate industry, it's called the cap rate. If you pay $100,000 for a house and you make $10,000 in rent, it has a 10% cap rate. If you make $5,000 a year, it has a 20% cap rate. You have to figure out how much percentage of the value of the house you're getting to kind of figure out, does it make sense? So we saw people paying $400,000 for a rental house that was renting for $700 a month. It's like, that doesn't work. In any long-term situation, only in 2007 did that make sense. And then, of course, we remember, as long as you had a pulse, you could buy 20 houses. You didn't even need money, you know. So with real estate and all the factors that went into here, we never talked about conservative investment strategies. But then 2010 came, and these rates may be high because most of you are probably getting 0.01% today. So let's look at another decade. I remember this decade because I spent 13 summers farming in the Skagit Valley, and I was a fast picker. And I remember my savings account, I was earning 12.5%. That was like $1 a day in interest. I was on cloud 9. I thought, this is great. This is awesome. I wasn't trying to buy a house, obviously, at the time. So interest rates on your bank savings accounts, you can see what they were back then. But again, with all these different things, now we're at the really, really low. It's a new period of time. Now we're going to talk about conservative investment strategies, essentially in a low interest rate environment. As I mentioned before, if your money markets are paying 5%, there's your strategy. You don't have to worry about anything else. But we don't have that anymore, and we're unlikely to have that for some time. So one way to look at investment strategies is, and I'm excluding your personal residence and your real estate, I'm talking about your investable assets outside of that. One way to look at it is just to break it into 3 basic types. I think that's the easiest approach. I'm calling them A, B, and C here. Yellow, green, and red is another way I may refer to them. So in the yellow column, we have cash. Why do we have cash? Is because we need, you know, things come up. You got to have cash. You don't want to have all your money in that because there's no potential of growth. It can only go up in value. Actually, this should be a very short arrow right now. It can only go up slightly, ever so slightly. It can't go down. It's liquid, another advantage of it. But you don't get any returns. That's the disadvantage right now. So your CDs at the bank, I have a guarantee. They basically guarantee you will not cover inflation. Here's your guarantee. You'll get something, but not enough to cover inflation. You will be going backwards with any cash type investment. An interesting thing about cash is if you were to compare the investments in things producing less than 1% a year in interest. And that would be cash in banks, money markets, most CDs, short-term treasuries. The value of all of those assets is about equal to the entire value of all the corporations on the New York Stock Exchange right now. The amount in bonds well exceeds, in just treasury bonds alone, exceeds the value, or is close to the value of all the stocks on the New York Stock Exchange. So this is a huge area. One of the reasons it's so huge is because people just don't know what to do. They're putting their money in CDs and money market, and they're like, well, I don't know what to do. And as we talked about it, they don't want to buy a rental house in their retirement. They don't want to buy stocks necessarily with all their money. So that is a huge area of the investment market, but essentially it's uninvested. But we need it. We need some of it. But in our example of a conservative model, maybe we pick a percentage. It might be 5%, it might be 10%, it's whatever it needs to be for you. That's something you would decide. Let's jump over to the red section. That's your standard risk profile type investments. What that would be stocks, any mutual funds, ETFs. Bonds, as we covered in the last class. Remember that statistic that if 20-year bonds, if the rates go up 4%, you'll lose 39% of the value of your bond. They have a lot of downside. That's why the arrow goes up, it goes down. So you have potentially very high returns. You have potentially very high losses. Depending on which decade you were investing, kind of determines how you went. You invested in the 70s, you hated the markets. 80s and 90s, you're a genius. 2000s, don't like the markets again. This decade so far, we like them so far. So it's kind of a timing thing. The bond market's slower to react. This also includes commodities, oil and gas, limited partnerships, pipeline type of things. The commodities includes currencies and metals, both common and precious, copper versus gold and silver. It can include agriculture. There's just a lot of different things. Real estate stocks, mostly commercial buildings, that kind of thing. All of that's in this category. It's stuff that you buy because you think that there's a chance for exceptional returns. And so that's what that category is. I'm going to show you some examples in a couple of slides that really bring it home as to the difference between investing in that category before you retire and after you retire, and hopefully that'll shed some light. The third category is a category you probably aren't as familiar with. We touched on it in the last class. This is the category put out by the insurance industry. We talked about annuities and how that's too broad of a term. This is a particular kind. It's not the variable annuity. Remember, I didn't like the variable annuity because of the fees necessarily. There can be, depending on your timing, they can be okay if you buy them at the right time, but you have to be real careful about them. They are in the C category. You just have to know that when you're in a variable annuity, they're here. A fixed annuity is here. An indexed annuity is here. So depending on the structure of the annuities, you might have different ones for different purposes. Let's talk about the fixed indexed. They have only an up arrow with no down arrow. That's because the fixed index products make sure you don't lose in a given year. But they are trying to give you moderate returns. Not low or no returns, but moderate. Not high, moderate. They can be tax deferred. One of the disadvantages of them is that they are somewhat illiquid. You can, after the first year, take 10% out of these things. But generally you don't, anybody doing retirement planning Sometimes they'll say, oh, I need access to my money. Well, if you're 65, you're unlikely to need all of it by the time you're 72. So maybe some of it's 7+ year money, and some of it needs to be liquid, your cash, and your C, A and C can add up to be your liquid. So this has become very popular. The main reason is because of that slide I showed you earlier, where your cash investment returns have gone down to next to nothing. So with the same risk, you can have something that gives you the market returns with a cap at 6, a floor of 0, or there's one out that gives you a blended return in an up year, -1.5%, but in a down year, you have no loss. So for instance, if the blended return did 3, you get 1.5. Does 13, you get 11.5. Does -13, you don't have any loss that year. So these kinds of things can be good to protect your investments, and then they can also offer cash flow for life. So let's do I love these slides. We're going to talk about the difference between the accumulation phase and the distribution phase of your life. So we're going to use some real numbers here. This is 1980. This is 2009. It's 30 years. These are the S&P 500 returns during those 30 years. We were just talking about this. We have a teacher here, says, you know, my annuity was pretty good, a tax-deferred annuity when I was teaching. I said, 80s and 90s, and that was pretty good years. We have, in 20 years here, I see 3 down years. One was 10, one was 7, one was 2. I see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 double-digit years. That was a good time to be invested, 80s and 90s. 2000s came. I have 4 downs, 6 ups. All 4 of the downs double-digit in this example. So, what if we had a pile of money in 1980 and we were not in the distribution phase in our life? We were able to leave that alone, and we put it all in the market. Well, we can see the market was great. At the end of 30 years, we had $5 million. It's pretty good. Love the market. Let's all do the market. It was up to almost 7. Then 08 happened. It got down to close to 4, and then recovered to 5. So that's pretty good. But let's say that if this is A and this is Z, let's put Z at the top and A at the bottom and inverse these returns. What would happen if in the early years we had all the negative years and then the later years were positive? Well, due to the commutative property of mathematics, they end up with exactly the same number, because when you multiply numbers together, it doesn't matter what order you multiply them by. We're not adding or subtracting, we're just multiplying. Now how you get there differed, because in this example, because of the bad years, our 500 was down to 376 in year 10, whereas at 1.6 over here, but then it recovered. They're very different, 1.9 versus 6.1. We get down here, but they end up at the same place. So what I encourage young people to do, they're 25 years old, 30 years old, whatever, their 401k plan, put it in the market. You got time. If you think the market's going to be up, you don't care what order it comes. It doesn't matter. As long as it's going to be up, you're going to take advantage of that, and you'll be doing great. You may not do as great as this graph, because I don't think the 80s and 90s are going to replicate. But if you think it's going to be up, you'll be up. You don't have to time it. Just keep putting money in. Take your free money. Keep putting it in. I've never met anybody, because I get asked this, well, how much should I put in? Should I put in more And I say, well, up to this point, I've talked to a lot of clients that have retired, and I haven't met the one yet that says, darn, I wish I hadn't put so much darn money into my retirement plan. What was I thinking? I haven't met that person yet. So let's change this up. This is accumulation phase of your life. Let's go to distribution phase. Same person, 500,000. But in this case, he's going to take some money out each year to live on. Back then, we were told 6% is fine. You don't hear that so much anymore, but back then that was pretty reasonable. And he's going to take an extra 3% each year for inflation. So the first year we see $500,000, $30,000 withdrawal, but a big increase in the value. So at the end of the year he had $610. He says, all right, I'll take 3% more and 3% more. And every year he's taking 3% more. He's taking 70 grand out in year 30, and he still has $1.6 million. I still love the stock market. I've shown you 3 examples where we should just buy the stock market. But let's do that one more look, but let's invert these returns. And let's say this guy's 65, he had 500 grand, he's taking 6% out. Whoops. Now look, because the negative year was early and it really affected his balance, the positive returns just really aren't enough to get him back. The negative returns continue to drain. So this guy with $500,000 in the market at age 65, all he has to do is go back to work at age 79 and he'll be fine. Oops, that didn't work. So whereas one plan worked under either situation in the accumulation phase, the plans don't necessarily work in the distribution phase. We have to have a solution for this. I don't think anybody in here wants to go back to work in their 80s. And these are real numbers. Could this repeat this last 15 or 14 years? Well, as I look at that, I see 10 up years and 4 down. Sure it could. It takes one really bad year to just crush your retirement to where you can't recover if you're living on that money. Any aha moments out there? This is a really important graph. So let's take a look at possible scenarios to solve that issue. Let's say, or let me go back one. Well, I think I asked in the last class, in the last 10 years, how many years were up, how many were down. As we know, 9 years were up in the last 10 in the stock market. Only one down year. It was really tough. So let's show this 10-year period. We see 26, 13s, 23s, a 12, a 13. I got 5 double-digit pluses, and I have 1 negative. So it was actually a pretty good 10 years, last 10 years. So what if we'd have put 10% in cash and 90% in the S&P 500? Well, during that time, cash averaged about 3%. Remember, it was 3, it was 5, it was close to 0, about 3. This is the S&P returns. So the S&P had a nice run during that year, even though it had a really difficult year in 08. And so at the end of that time, this person had a 59% increase in the value of their assets. But what if their neighbor was going with a conservative approach? How would he have done? Probably not as good, right? Let's say that instead of putting 90% in the S&P, they only did 40% in the S&P. And instead, they put 50% in one of those insurance products with a floor in the ceiling. The average ceiling during that time was about 7. Today it's 6. Okay. Just as cash was about 3. It may even be higher, but we'll just use 7. So we can see the cash grew because of the 3% growth. The S&P 500 grew from, it's hard to see, but it's 200,000 there. It's 324,000 at the end. And this little guy grew 7%, 3%, 7, 3.5. It didn't change in the down year. Went up 7 and 7 and 0 and 7. So this 250 became 400,000. We add these up. This portfolio went up 58%. The last portfolio went up 59. Isn't that interesting? A very conservative portfolio could have gotten you very close to what an aggressive portfolio got in a good decade with one bad year. So let's do another example though. Let's shift this back a few years. Instead of the last 10 years, let's take the 10 years beginning in the year 2000 through the end of 2009. What would that have looked like? Well, during that time, cash was actually paying even higher, maybe 6% average during that time. We're going to keep this at 7, and here's the actual S&P results. This wasn't so good of a decade. We had the 4 down years. We had 2 crashes. We had a dot-com, 9/11, we had the recovery, we had 08, and then a recovery. So the cash went up. The stock market 450 became 341. So 10 years of investment, 90% in the stock market, 10% in cash, because we didn't know what else to do. We're down $91,000 or 18%. $91,000 on a $500,000 investment invested for a decade. So what happens if we put that conservative strategy over the top of this? This is where it shines. We have the cash, we have the indexed annuity, 250, doesn't go up during the dot-com crash, but it doesn't go down. Then it starts going up, it stays the same in 08, goes up in 09, so 250 became 349. The 200,000 here became 151. At the end, instead of losing, 91,000, we made 68,000. Almost 70,000. So $160,000 increase in the portfolio value in a bad decade. That's where it shines. The conservative investment strategies. Doesn't that make sense? A conservative investment strategy should shine during a bad decade. But I think the point is also, during a pretty good decade, it could do all right. If I were to show you the 70s, that was another horrible decade. It did really well. The only time it doesn't do as well is if you believe that we're going to have a repeat of the 80s, where every year is up. So if anybody in this room thinks that the next 10 years are going to be one of the longest extended bull runs in the stock market, then you probably don't need this strategy. I know one person, Mr. Shane, that might think that. And I hope you're right. If you're not real confident about that, then going with a conservative investment strategy may not cost you any money in an up market and only totally benefit you in a down and allow you to sleep at night. So I wanted to bring up this example because this is not something most people know much about. Again, it gives you moderate returns. It's not designed to give you crazy returns. If we have, again, a massive bull run in the market, at the end you go, I would have had more money had I put it all in the stock market. But hopefully you're also saying, I had some in the market, and I did pretty good on this, and I slept pretty well during that decade. That's the point. This is not the plan I give to a 30-year-old necessarily. This would be the plan for somebody nearing retirement, in retirement, post-retirement. Any questions on this? And I did a very simple example, the simple fixed index annuity with the floor and the ceiling. Again, there are other versions which are more growth oriented. This is kind of a, I call it a CD on steroids, this particular insurance product, because if I compare a 7-year CD or 7-year treasury to a 7-year fixed index annuity, well, the treasury I know I'm going to get less than 1%, or right around 1, the CD close to 1. This will have probably several years at 6, maybe 1 or 2 zeros and 1 or 2 in-betweens. At the end, you know, whatever my return is, it might be in the 20% range or whatever. The other one, I'm 7 or less.
Ryan, what's
Yep.
the difference between the green column and indexed CD?
An index CD, which version of an index CD are you talking about?
Let's just use the floor and the cap
Mm-hmm.
like you have there, S&P 500 or...
Yeah, the question was, what's the difference between this and an index CD? The index CD would probably go into the category like this. Again, annuities can be this category, this category, this category, depending on the kind. So again, there's, you know, the CD, though, a strict CD is definitely the yellow category.
Right.
But a variation on that could pop it into this.
Is it taxed differently?
Yeah, the annuities are insurance products, so they're going to be tax deferred.
Okay.
Yep. So I want to talk about an example. I had the opportunity to write a chapter in a book called The Black Book on Personal Finance, and my chapter was asset allocation. And what I covered in that is I did a case study of the crash from 2000 through 2002. And everybody said, oh, the stock market crashed, stock market's bad. And that wasn't the conclusion that I came up with. What I came up with is that we had bad asset allocation due to our reliance on indexed funds. And let me explain what I mean. During those 3 years, we know the stock market dropped half its value. So clearly it was a bad market, right? Well, the problem was that in an index fund, the index is going to buy the most of the biggest companies. It has one criteria. A computer just says you're big, we'll buy a lot of you. That's it. And that's where most assets are invested. The S&P 500 is an example of that. So during those 3 years, there are 10 major segments of the economy: technology, telecom, healthcare, real estate, banking, consumer durables, energy. You know, there's all these different sectors. A lot of you may find it interesting that more of those sectors went up than down during that 3-year crash. Did you also know that more stocks went up in value than down during that crash? How is that possible? What kind of funny math are you giving us, Mr. Evans? The problem was that more than 50% of the entire value of the U.S. stock market was in telecom and technology stocks, computers and telephones. And all other industries combined represented less than half of that S&P 500's value. Because all these dot-coms knocked them out. All these dot-com stocks with no real product knocked out the company that was, you know, providing, manufacturing or energy or pharmaceuticals or whatever. They got kicked out and these replaced them. So the index bought a huge amount of the same industry stocks. When they dropped 80%, the average appeared to drop 50, yet more companies went up than down. So we didn't really necessarily have a overall stock market crash. What we had was bad asset allocation as a result of indexing. But indexing has been the way that most people get diversification. John Bogle created the first S&P 500 index with the Vanguard funds more than 50 years ago, because most people couldn't buy a number of stocks. It was hundreds of dollars a commission to go to Dean Witter and buy stocks, so you just couldn't buy a bunch of stocks. But you could buy this new mutual fund and you own 500 of them. Problem was that they didn't put any analysis into the 500 companies beyond how big they are. So for instance, if you put $1,000 into the S&P 500 or Vanguard 500 index, you might have $60 of Apple and $50 of General Electric and $45 of Microsoft. And you start getting down the list to Southwest Airs and Applebee's and those companies, you have about 10 cents. I mean, there's just almost nothing. It's all in those top big multi-mega companies. So your index goes as they go, whether they're overpriced or underpriced. If all of them are dot-coms and telecoms, that's what you're getting. So it's not a smart index, it's just a real basic index, and it has a problem. And so that's what I wrote about in the book. It was interesting years later when I woke up with that download from God. I'm convinced, because I remember Tracy was there and it took me an hour and a half to tell her everything in my head. And it said there's a better way to build an index. It should be based on earnings and valuation. You should buy low and sell high. So let me give you an example. If Apple, when Apple was $400 a share, it went to $700 and everybody thought it was going to $1,000. Remember that? And then it went back to $400. So the index owned $40 worth of it out of 1,000. And when it went to 70, when it was really overpriced, it bought more. So it bought a bunch at 70. And went back down to 40, it says, oh, now we'll sell those shares we just bought. We just bought a bunch of shares at 70, we're going to sell them back at 40 again. By design, it's built to buy high and sell low. That is an index. Kind of backwards, huh? So an evaluation approach, I'd own a certain amount at 40, or at 400 a share. When it went to 700 a share, the valuation index says it's not undervalued as much anymore, let's sell some. When it went back to 400, it says it's undervalued again, let's buy more of it. Buy low, sell high. Seems to be a better approach. So those are the impetus behind the domestic and international exchange traded funds that I was able to launch on the New York Stock Exchange, creating a better index. I think they're better. They're doing way better than the Vanguard index, or the domestic funds, more than 9% ahead in return over the S&P 500 over the last 12 months. They're making a lot more money than me because they have a better marketing than I have, but I have a better product. So hopefully as time goes by, the world will see the wisdom between a valuation index. But I wanted to talk a little bit about that because when people ask, do you think the stock market's overvalued? I'm like, ooh, some of it. Do you think it's undervalued? Some of it. Well, I think the ones at the top of our index of our Madrona strategy are undervalued, and the ones that we kicked out or at the bottom are overvalued. So it kind of always depends. At all times, some of the stock market is undervalued and some is overvalued. You have to get back to that discussion I had on PE ratios and PEG ratios on a global basis to see relative to historical values, is it undervalued or overvalued. That's an indication on the broad market. But then you get more specific into sectors, companies, and so forth. It's really important to look at valuations. Take a moment to talk about asset allocation. There are a lot of different categories of investments. Once you get that money out of that 401k plan and you start, one of the disadvantages, I suppose, is now you have 20,000 choices. Now what do you do? And so that's kind of what I do. And so I just listed a kind of a sample model portfolio of some different components that might be in a standard portfolio to give the diversity and the overweight to the undervalued sectors. Again, there's so many different areas: large, mid-cap, small-cap, U.S., foreign, emerging markets, 15 major categories of bonds. You've got preferred stocks and metals and commodities, as we mentioned, arbitrage funds. There's oil and gas limited partnerships. There's all kinds of stuff out there, and having the right mix to reduce your volatility is really important for especially someone nearing retirement. If they were younger, they might get rid of half of these and just go more aggressive with that. But that's part of the old model. When I say old model, what I mean is if you go to most big brokerage houses that have more of a standard approach, they'll do something that somewhat replicates this to a degree. But that's going to be where all your assets are. And we just went through an example saying, yeah, but what if we don't have a great decade? Then where am I at? Well, I'm way down. And I had somebody come in recently that said, I went to my broker, I said, I don't want to lose any money. My husband's 85, I'm almost 80. What should we do? Well, he put him in a portfolio that was all bonds. Rates went up. Their account went from $1 million to $910,000. And she's like, what now? Just lost 90 grand. I wanted this to stay steady. His recommendation was just wait it out. Wait it out. So you're just waiting for, remember that graph with the interest rates where it was the lowest it's been in 50 years? It's never been that low. All they have to do is wait until it gets that low again. Maybe in another 50 years, 60, 70. I think he's 85. Wonder what his RMD would be at 145 years old. I bet it'd be pretty high. I don't think that was a good answer. I don't think it addressed their concern. But the old model is stocks and bonds and alternatives. And that's fine for a part of a portfolio. The part depends on your age, risk tolerance, cash flow, all that kind of stuff. But don't make it the portfolio if you're interested in maybe asset preservation, income strategies. That's the old model. That's what you're going to get when you go to 98% of the advisors out there. They don't know what else to do with it necessarily. So as a part of the component, I've added some other parts here as an example for somebody maybe 70 years old that says, gee, I don't have a pension. My cash flow is kind of not so great. I have various assets. I don't want as much risk as I've been taking. What do you suggest? Well, we might end up with an allocation to all of these, an allocation to cash, an allocation to that strategy I showed you, the green strategy with the floor and the ceiling. And if, again, they say, yeah, I don't have enough cash flow, maybe an allocation to a guaranteed withdrawal benefit, which is a form of this, but the kind that essentially becomes a pension-like asset. It pays you for as long as you live. It takes away longevity risk. So if you plan on living into your 80s and 90s, then that's a really good thing. You win, the insurance company loses. If something happens to you prematurely, then your heirs get the part that you haven't received. So it's still an investment, but it takes away longevity risk. So they might have an increase in their monthly cash flow, some safety of investments, some liquidity here, some potential to go up, some potential to go down. And let me talk about how I quantify risk for people, because there's a lot of words that we banter about. Gee, are you aggressive or conservative or moderate? You're like, I don't know. Political views? I don't know. What are you talking about? What do those words mean? How much risk am I taking? The real question is, how much would I lose if the market does what it did in '08? Isn't that the question? We have another lousy market. What happens to my portfolio? Well, here's how I could quantify that. In this example, what would happen if the market dropped 30%? Well, this part was the amount that you get every year for the rest of your life. It doesn't have any market risk. Cash doesn't have market risk. This doesn't have market risk. You wouldn't earn anything in that year, but you wouldn't lose anything. This has market risk. But let's say only half of this was in stocks and the other half was in bonds that were not correlated to the stock market. So assuming that the bonds didn't do anything plus or minus that year, it was just the market that dropped, we'd have about 22.5% losing of the value, losing 30%, so between 6 and 7% loss. So if you had this portfolio, how much could you lose if the market loses 30%? 6 to 7. Are you okay with that? Yes, no, or maybe? Okay. We can adjust these numbers until we get it. And sometimes, and then I'll flip it around on them too, though. Let's say the market's up 30%. Okay? Well, this part went up 6 to 7. This part might have been flat. This part didn't go up. This part went up 7%. This part didn't move. So you might have gotten a 10% weighted average return.
But you slept good at night.
You slept good, but are you okay with 10 if the market goes up 30? Now we're starting, sometimes I say, no, I really need more than that. Okay. Well, then you've got to increase your risk tolerance on the downside too. I don't want to do that. Okay. So you just want a high rate of return without any risk, right? Yeah. Don't we all? We have to make choices. In a moderate year, this would do really well, because this would make money probably on the stocks and the bonds, and this would make money, and only this part would be not subject to market risk. The returns are already built into this, they're guaranteed. What if something happens to me? Oh, question.
And what's on that graph on the right, what's the rust-colored segment?
The rust-colored is the fixed indexed annuity. That would be the green, column B, that green of the yellow, green, and red.
And the one above that in green is...
That's a variation on that. That's the fixed index annuity with an income rider where it's paying you an income for life. There's basically two major flavors of that. Next question I would get was, what if a catastrophe happens? How much, you said this is somewhat illiquid, how much could I pull out? Well, if this was $1 million, this takes 4 days. There's cash, that's half of the portfolio. This part you can take 10% out. So if you had $1 million, you could take out $525,000. So just over 50% of it is liquid. So we talked about what would it do in an up market? What would it do in a big down market? What's it do in a typical market? How much is liquid? How's my cash flow? If they had $250,000 in this, maybe it's paying them $20,000 to $25,000 a year for life. well, along with their social securities and whatever else they have, maybe that's okay. And so I work with all these numbers to kind of figure out what's the right mix in an up, down, sideways market. What makes you sleep at night? I frankly, in my 30s, I didn't care what the market did. I'm not taking that money out for 100 years. It felt like 100 years when I was 30. Well, now that I'm in my 50s, it doesn't seem like 100 years away anymore. But early 50s. Very early 50s. But we change our opinions of investment strategy as we go on, and sleep becomes security, because we don't want to go back to work, as I pointed out in that one example. This simple little graph won a Nobel Prize about a year or two before I was born. Harry Markowitz did a study on asset allocation. Most people think, well, if I have 100% stocks, I get a higher return and higher risk, and if I have 100% bonds, I have lower return but lower risk. Well, that's true to a point. But if that were the case, as you go up here and have a higher return, and you go this way to have higher risk, if that were the case, these lines would have just gone right one to the other. But an interesting thing happened when you started adding stocks to a portfolio. The risk went down and the return went up. Because, remember that graph I showed you where you had bonds, interest rates go up and your bonds lose. If you're all in bonds, had you just had some in stocks, during that same time period, these two asset classes are uncorrelated, meaning one goes up, one goes down more often than not. The other one goes up, the other one goes down more often than not. So when the interest rates were going up, guess what else was going up? The stock market. So 75% of your portfolio was bonds, it went down, but 25% of your portfolio was stocks, and they went way up. So instead of losing this much, you lost this much. So by adding stocks, you decrease your risk, increase your return. But as you add more stocks, your risk starts going up. So I use this approach. This is a very simple approach, but how do you allocate a conservative portfolio on that part of the assets or in the stocks, bonds, and alternatives? I generally want around 25 to 30% in the equities market, because I know based upon this graph that that would put you at the lowest risk of any combination relative to return. And then I'll add components to this and try and make this thing go up and to the left. And that's part of my job to do. Wouldn't it be nice to know the right time to retire? I know some people in this room have taken advantage of this. We actually have a financial planning software that we punch in everything. I mean, your Social Security increases, inflation, spending post-death of the first spouse based upon a projected age of, say, 95. We have rates of returns on different asset classes, taxes, pre- and post-retirement. They're different rates, typically, for most people. We run these things out, and we can actually plug in your data and get a pretty good feel for some what-ifs. Can I retire at this age? What if I move it to that age? What if I invest in different things? We can run some different scenarios. And it's actually a way to, most people when they think, when should I retire, or he retired at 62, I guess I can, I don't know. They don't put there's not a lot of information available to tell you the answer to this question. Wouldn't it be nice to run that? I've seen lots of people in here I've done this for. To run that and say, what do my assets look like throughout my life given certain assumptions? Now granted, the next day, whatever I printed for you isn't going to be exactly accurate. Things change. But we can update these things. But they should be relatively close given uncertainties are going to happen. But at least we can have some knowledge that we took the time to review all the components to figure out when, how my retirement might look, how much money do I have to spend the rest of my life, what's my cash flow, what are my taxes, what are my strategies. So I think that's a really important thing. We offer that, again, for free. So that's why I've had a lot of people take me up on that. Here's what the graph might look like. Here's an actual example of a client I have in Oregon. They had some rental houses. They were going to make a sale here. They were spending more than they're making. Another sale of a rental house. And they were fine through 100. I did not calculate the sale of their $1 million+ principal residence. It's kind of a backup asset. I also don't calculate a decrease in spending as you get older. So this is kind of a tease about it. Your worst case scenario is that you're going to be just as active at 95 as you are at 65. You're going to spend just as much money with inflation added to it at 95 as 65. Take just as many trips. What if you live that long and you're very active and you're spending all that money? Are you still okay? This says yeah. Sometimes I'll do this. I remember this poor attorney. He'd been working hard but wasn't really good at saving. He wanted to retire at 62. He was going to be good till about 73. You know, I can't build a house without lumber and nails. So, sorry, you got to work about 8 years longer than you planned on. So sometimes the answer is not the right answer. Hopefully, well, it's the right answer, but an unfortunate answer. We'll put it that way. But we can do this. We can also one interesting thing that has been real popular the last few years is something called Social Security optimization. A majority of Americans take Social Security when they turn 62. When they do that, the average present value of future expected earnings from Social Security are between $60,000 and $110,000 less than what they could have been had they invoked the proper strategy. For a married couple, often the proper strategy is for the higher earner to elect under Social Security but not take it, and let the spouse have half of theirs until that higher earner turns 70, and then they get the full amount. Because every year they wait, they get an 8% increase in payments for life. So by waiting, you're really increasing the present value of your earnings, yet your spouse gets to have half of yours and it doesn't lower the amount you're going to get for the rest of your life. This is a mouthful. Trust me, we plug in your personal data. It runs just 100 different combinations and permutations to figure out. It will tell us the proper strategy to use. And every time I've run this for a married couple, it seems like we get pretty sizable difference between taking it early and maybe using one of these strategies and how much money they're going to get relative. And it can be a big difference. So if you know anybody that's...
Depends on how miserable you are at your job, too.
Depends on how miserable you are at your job. Yes. So we may run an analysis, and since I hate to pick on Boeing, but there's a few miserable people that work at a job that maybe they aren't too thrilled about. And so they're really counting the days to their retirement. We would have that spending. We'll take a look at the spending. That's not something I really help people with, though. I'm on the asset side. I'm not going to tell you not to buy your lattes or go to the movies. That's not for me. Yes?
Once you start Social Security, can you stop it?
I believe you can. I mean, I know people have gone back to work maybe, and they get to where they they have to give it back. And so then they'll want to suspend. The strategy here is called file and suspend, but that's not a start and stop, what you're talking about. Yeah.
Do you think Social Security is viable for the baby boomers that are going to be?
Great question. Is Social Security viable for the baby boomers? Yes and no. In its current state, it is absolutely not viable. It will run out of money. No question about it. 2 workers for every 1 person taking money out. There's no way. What they're going to do is, I think I'm the youngest of the baby boomers, or real close to it. When I get to near that age, the retirement age will no longer be 62 to 65, 66, whatever. They're going to have to raise it to 70 or 72. By raising it to 72, it makes it solvent for the next 50 years or whatever it is. But that's going to be the reality. Which, you know, when you look at it, when they started Social Security, you could have it at 65, and the average lifespan was about 66. So it was meant to be their last couple of years. People didn't retire when they started Social Security. There was no such thing as retirement. You worked until you couldn't work. So maybe you worked until, 65, and you know, whatever. You didn't have a lot of time left if you just didn't retire. So maybe you had a couple years where you just couldn't work. Those are the years you take your Social Security, and that was it. It was never meant to be the 30, potentially 30-plus year retirement that it is now for people. It was never meant to be that. It doesn't have the funding for that. There is no Social Security fund. I saw a great cartoon on that. They opened up the vault, the Social Security fund, and there was a little slip of paper that said, I owe you 1,000,000,000, gazillion zeros. There is no fund. So we rely on workers, and we don't have enough workers to support it unless we just change the numbers, crank it up. Another 25 years, retirement age will be 80 to keep it solvent. Or they'll have to reform health care or some combination of that.
But they don't have to cap it either. I always think these people are making a lot of money, are making their money in America. They can give a little more when they're making that kind of money.
The question is...
100,000 some?
Yeah, the question is, can they just increase the tax? The reality is, and if we start talking budget here, the reality is if you taxed every corporation, say, at 100%, you would not balance the budget. There isn't enough corporate profits out there to pay what we spend. That's the real number.
I think of salaries.
Salaries? Well, we could tax salaries at 100%. I'm talking to somebody retired, huh?
Yeah, but what I'm saying is, if I were making $200,000 and I had to pay Social Security or out of my $200,000 on my checks all the time, at $200,000, I'd still have plenty to live on.
The question is, at $200,000, shouldn't you pay more in Social Security?
Right.
You absolutely do, because the people at $200,000 versus somebody making $20,000 a year, the person making $20,000 a year might be paying
Well, you're talking about percentage-wise.
percent.
Yes,
Yeah,
I agree
the
with
dollars are going to be hundreds to 1,000 versus tens of thousands of dollars for somebody making more. Even though they're not going to get a pittance of that back, they are absolutely taking on the lion's share. Another question.
Annuity question, Brian.
Mm-hmm.
Is there any advantage in taking an annuity from a nonprofit? The nonprofits are getting more and more, it seems to be, in the business of selling annuities. The Cougar Fund, for example, Foundation, or the U of W Foundation, churches,
Mm-hmm.
organizations.
Right.
Is there an advantage to taking an annuity from a nonprofit versus a profit?
The question is there an advantage buying an annuity from a nonprofit versus a profit company? The problem with most annuities are that they're sold rather than planned, meaning that if I have an annuity to sell, let's say I work for you're picking on my Cougars there, so I'm a Cougar insurance agent, and I'm selling Cougar annuities to other Cougars. And I'm looking around the room, if you're all Cougars, I think you need my annuity, because that's what I'm selling. If I'm a candy bar salesman, I think everybody needs a candy bar. Well, I know I don't. I'm trying to lose some weight. But you see, I don't think that that's how they should be sold. If it's part of a planning process where it makes sense that you're buying the right one for your specific situation, that's fine. But that Cougar annuity sales guy probably isn't a proper financial planner.
Versus an insurance company who might have higher costs?
They're going to be representing, the question was, will they have a better plan than a regular insurance company plan? They're actually going through a regular insurance company. They're just getting
They're
paid.
a conduit.
They're just a conduit like anybody else. Anybody that has, the policies that are out there are nothing all that unique. I mean, if somebody's selling insurance, they should be able to go to any company and sort for the best one for your situation. But the real question is it appropriate? Was it part of a financial planning process? Then fine. But most, I'd say 90% of them were sold without any other financial planning, and that's not necessarily the fault of the insurance person. It might be that I just didn't want to tell them what else I had, but that's not proper planning in my opinion, but that's, my opinion. But it's good to just go through the process. I mean, I would encourage everybody that hasn't done so to go through the process of some kind of financial planning. Ideally, after these couple of days of all these topics, you maybe know some people in your life that you care about, that you think need to go through this process, and maybe you have some influence over them and can encourage them to check into that. I'm happy for anybody that's here that has somebody that they want me to talk to about their own situation. I'd be happy to meet with them. I'm not going to charge them for that. I just really enjoy what I do. I think I have some value add to most situations. I'm sure you could tell I have opinions, and they're pretty strong about doing it right. And so I would encourage you to reach out to those folks if it strikes you to do that, or your own. So with that, any questions remaining? I'll be around for a little while if you have something you want to ask me. And again, I just mentioned here that you can sign up for a strategy session or tell somebody about it. But I want to thank everybody here for their being awake the whole time and really being involved with this. I hope you had some aha moments, as I mentioned. Covered a lot of ground, and I just really appreciate your attendance these 2 nights. So thank you.